Hi, I'm John Pasalis, housing analyst and founding broker at Realosophy Realty, where I lead our team of agents in providing data-driven real estate advice to home buyers and home sellers throughout Toronto and the Greater Toronto Area. We launched this Toronto Real Estate Summit because we're getting a lot of questions from consumers about the volatility in our economy and our housing market that was brought on by the COVID-19 pandemic. So we're going to be talking to leading economists, housing industry leaders, personal finance experts, and real estate agents to get a better understanding of what's going on in our markets today and what are some of the key things that we should be looking for in the months ahead so you can all make smarter real estate decisions. If you have more specific questions about your home buying and selling needs, please feel free to email me anytime at askjohn@movesmartly.com, and I hope you enjoy this interview.
Hi, I'm Urmi Desai, Head of Content and Editor of MoveSmartly.com. I'm going to be talking to Jason Mercer, Chief Market Analyst at the Toronto Regional Real Estate Board, TREB, where he leads efforts to ensure that realtors and their clients understand the latest market trends. I'm going to be talking to Jason about where we are right now, where the market's going to go, and maybe where it needs to go, given that Jason has a diverse background, including in the land planning sector. Hi, Jason. Great to have you here.
Thank you very much.
Jason, can you tell us what a typical week looks like for you in your role as Chief Market Analyst at TREB?
Sure. I mean, I wear a number of hats at TREB. Certainly, the market analysis side is what brought me from CM8C to TREB, going on 12 years ago now. It'll be 12 years at the beginning of January. And so certainly, on a day-to-day basis, I mean, we're tracking what's unfolding in the market. Both in terms of residential and commercial real estate. Obviously, TREB members also benefit from additional data that comes from our third-party partners like RealNet on the new home side, Altus's RealNet product, and public records and what have you. So we take all of that information and kind of put it together into value-added products for TREB's membership, and in turn, they use that with their clients to help them make informed decisions on either buying or selling a property. And certainly it's important to note as well that a lot of our members are also active in the leasing market, whether you're talking about residential or commercial. So we produce a lot of statistics on the leasing front as well.
Great. So during COVID, did anything about your daily routine change?
Well, I think certainly, just like many other people working in the GTA and across the country and around the world, certainly from a physical location perspective, the majority of people are working from home. But fortunately, we were able to make that transition very quickly at the Toronto Regional Real Estate Board, and so basically all aspects of the board's operation are now more or less off-site. And I think you've seen that more broadly in the real estate space as well. And if you think, we moved from March into April and saw a real a drop off in sales, but we've seen an improvement since then. And I think part of that is testament to the fact that our members, realtors, have become very flexible in terms of how they've been able to cope with the state of emergency, how they've been able to work in an environment where there are no longer, say, traditional in-person open houses. We've seen more virtual tools being used to show a property, to display a property to potential buyers. And I think you've seen a real flexibility and innovation on the part of a lot of our members and their clients in terms of trading real estate over the last couple of months. And I think that's showing through into stronger statistics in June.
So the latest market numbers are out. What are they telling us?
Well, I mean, certainly if you think back to the first quarter of this year, we had actually seen a really strong handoff from 2019. And we were seeing an acceleration in sales on a year-over-year basis, and also in terms of price growth. And that was right through, roughly March 15th. And, after that period, as we moved, from pre-COVID into the COVID period of times, we saw, an initial, drop off in activity as people, started to sort of resituate themselves in the marketplace. I mean, obviously there's a lot of uncertainty in terms of the labor market, in terms of the broader economy. And so we saw, sales drop below 3,000 You know, for instance, so from my perspective, working at the Toronto Regional Real Estate Board and covering the housing market longer than that, I mean, that was a pretty steep drop off over the course of, you know, a couple of weeks. But I think also, you know, testament to this market and testament to the regional economy, we've seen a pretty marked improvement since then. We had over 4,000 sales in May, and then moving through June, you know, we were hovering right around the 8,700 mark, which put us just shy of where we were in June 2019. And so, you know, given that we were starting to see a pretty strong recovery in sales in the second half of 2019, as people had come to terms with the OSFI mortgage stress test, you know, that's a pretty good number, you know, relative to last year. And it's starting to get back onto the track where we were in the first quarter of 2020, where, you know, we were on pace to have a near record year in 2020.
So let's talk a little bit about that buyer demand. So it came back a lot faster than anybody expected. Why do you think that is?
Well, I think part of the reason, I mean, if you think about the GTA, it is a relatively expensive market, whether you're talking about, you know, the Ontario or Canadian perspective, or even internationally. And so, you know, you do require a certain income level to get into the home ownership market. Obviously, you know, dependent on the type of home you're looking to buy and where you're looking to purchase from a geographic perspective. But by and large, you know, you require a certain income level to get into the market. And if you think about, you know, how things have unfolded in the labor market, that the higher earning sectors on average were actually those sectors that were impacted the least by COVID-19. And I think one of the factors is a lot of those sectors, especially those that involve office work, were able to be a little bit more flexible. So they were able to, you know, move most of the people working in those sectors from the office to the home. And I think, you know, to a certain degree, that had a positive effect on consumer confidence, because, you know, you make that transition, now you're working from home and you're thinking, well, you know, this looks like it can carry on to a certain degree. So I'm a little more confident than, say, I was in April, in terms of, you know, retaining my employment over the long term, and by extension, you know, providing me with the ability to purchase and pay for a large ticket item like a home over the long term as well. And then, you know, I think as we moved through the second half of May and more so in June, we started to see this gradual reopening of the economy. And at the same time, you know, we saw the daily case count, you know, continue to trend lower as that reopening was taking place. And so I think that, you know, measured, cautious approach still did present, you know, a brighter and brighter light at the end of the tunnel. And so I think that feeds through into confidence as well. And so if you assume that, you know, a lot of people became more confident in their ability to retain their employment and see that income coming in, at the same time, you know, could see the light at the end of the tunnel in terms of the reopening of the economy, I think that, you know, was a major factor underlying the sales growth that we saw in June. You know, and not forgetting the fact that, you know, borrowing costs right now compared to even where we were in January are much, much lower. You know, both in terms of, you know, variable rates, which are based upon Bank of Canada decisions, or longer term rates, which are based on, you know, bond yields, and both of which, you know, we've seen, you know, a pretty steep drop off, and that's expected to remain in place as we move through 2021 as well.
So forecasting is tricky. And I'm wondering, back in March and April, when you were looking for prices to remain flat year over year by the year's end,
Sure.
Is that based on that uncertainty around how people would transition to the new working conditions? Is that what you were sort of looking at that point?
It was, and also, you know, you really need, because I mean, these are unprecedented times. So if this were sort of I don't think there's ever, you could say there's a standard recession, but if this were, you know, more of an economic recession where, you know, we'd seen higher inflation, or we'd started to see a pullback in equities markets and what have you, you could kind of use the past to predict what was going to happen, you know, across different sectors of the economy. I think, you know, as we moved into a recession that was essentially driven by a public health concern, and rightly so. I mean, you know, we can see the benefits of seeing people, work from home, of shutting down certain types of economic activity to benefit the population more broadly. But obviously on the flip side of that, there's a slowdown, the likes of which we hadn't seen before. And so, moving through April, moving through May, the jury was still out in terms of how sales and listings were gonna react, and how those trends were going to react vis-a-vis one another. And so what we saw, or what we ended up seeing, was sales and listings moving somewhat in lockstep. And so, if in February or the beginning of March, you're thinking about purchasing a home or thinking about listing a home, both sides of that transaction seem to take a similar step back. So you didn't have this scenario whereby, sales dropped off, whereas listings started to increase dramatically because of, people felt they're in financial distress or what have you. And so obviously, we need to see how that was going to shake out. Now it certainly appears that, sales and listings are continuing to move more or less in lockstep. And so we've retained, enough competition between buyers in the marketplace to support, the type of price growth we were seeing in the first quarter of the year.
And what is TREB's outlook now for where prices will be by the end of the year?
Yeah, so to give a little bit of a context, every year, either at the end of January or beginning of February, we've been releasing our market year in review and outlook report, and certainly this year was no different. And at the beginning of February, our forecast for the average selling price was right at $900,000, and that would have been up, fairly substantially from $820,000, give or take, in 2019. And I think that forecast still holds up relatively well. I mean, we were sitting, a little bit above $890,000 year to date. And that was taking into account, a couple of slower growth months in terms of price, both in April and May. And so assuming that type of relationship between sales and listings hold up, I think, $900,000 for 2020 is a reasonable target still.
So let's get back to this, the demand question. Do
Sure.
you think it's roughly the same split between end users and investors that we were seeing pre-COVID return to the market?
And that's an interesting topic, and I think it also kind of bridges us or provides a bit of a segue into the rental market as well. Because whereas we've seen sales bounce back fairly quickly, looking at June, for example, the rental markets behaved a little bit differently. And we're already starting to see that. I wouldn't put that all on COVID-19. We're already starting to see a transition in the rental market really moving through most of 2019 as well, where, we're still seeing growth in rental transactions for, say, condominium apartments, but we're seeing growth in the number of these condos listed for rent far outstripping growth in rental transactions. And so what that meant is that people looking to rent a unit in the market were benefiting from more supply, and so they could be a little bit more aggressive in their offers in terms of rents and what have you. And we actually started to see, rent growth move from what had been, high single digits to even low double digits down closer to inflation. And now certainly, as we've moved into the sort of COVID-19 period, we've actually seen rents dip year over year. And so it is a segment of the market that has seen more supply come online, has seen more investors listing their units. And there's probably a few reasons for that. Number one, if you think back to 2018 and the first part of 2019, rent growth is strong. And so generally speaking, when you're seeing, strong growth in price for a good or a service, you see more supply come online because people want to benefit from that. Investors will want to benefit. So I think, that was one factor. Number two, obviously, we've seen changes in regulations on the short-term rental side of things. And so if you're an investor that was pointed at the short-term side of the market, you may be thinking about your unit more in terms of the traditional rental marketplace as well. So that leads to more listings also. And then on top of that, obviously through COVID-19, if you think about the segments of the population who rent, more of those people may be working in industries that were impacted more so by shutdowns related to COVID-19, to the public health initiatives. And so that's obviously led as well to, a little bit less demand than what we would have been used to, say, in the spring normally. So, that presents, one picture of the investor side of the market, those that are focused on purchasing a unit. and renting it out. And so it'll be interesting to see how that segment of the market unfolds, especially with this gradual reopening of the economy that we're seeing. So a lot of these sort of population-facing, population-serving sectors that were completely shut down in April and May, now these are opening up again. And with that, people will likely have, better prospects in terms of their income moving forward. And so it'll be interesting to see how quickly the demand for rental turns around vis-a-vis the supply of units available.
Yes, because obviously, investor interest has been predicated upon these, I don't want to say exciting rent growth. It's not exciting if you're a tenant to see rents climb so quickly.
Sure.
But obviously for an investor, that's a positive return on their investment. Now, anecdotally, we're also hearing with tourism down, that's yet another question point around that short-term Airbnb
Sure.
Type rental. Did the June numbers show anything like more people, perhaps investors, listing their condos on the market rather than retaining it for short-term rental purposes?
Yeah, I mean, we're going to release the second quarter rental results over the next couple of weeks, but certainly, I mean, that's been the trend broadly. Seeing listings growth outstripping rental transaction growth, and I think on top of that, if you're thinking about someone who is pointed, forget about even put aside the regulations on short-term rentals, but just the tourism sector. I mean, that's a sector of the economy that there's still probably a lot more questions than answers in terms of how quickly that will open up moving forward. So, I think it's a reasonable argument that if you have a condo that you're comfortable in that short-term rental space, because, the GTA does benefit from a lot of tourism from south of the border and around the world. If you're not as confident in that, then, it's a reasonable assumption that at least some of those people may list their unit for rent. There's always the possibility as well that it brings a little bit more supply into the ownership market as well. In the sense that if you've owned a unit for 5 or 10 years, you've also benefited from a decent increase year over year for that period in the value of your investment, and so you may look to exit the rental market space as well. And so I think that the condo market in particular is going to be an interesting segment to watch. If you ask what could be the most sort of interesting in terms of trends, I think the condo market will be something to keep an eye on, both from the rental side and the ownership side over the next year for sure.
And more broadly, we're hearing from other experts at the summit cautioning us that some more economic setbacks may be down the near term, that it's early days. And some are wondering or suggesting that the real estate market bounce back may be short-lived. Our own John Pasalis described it as that, maybe analogous to the rush back to the hairdressers right after lockdown. What is your view on whether this real estate market bounce back is a short-term one?
Yeah, I mean, we've talked about it already. It seems like forever ago that this whole situation started, but it really wasn't. And so we've seen a couple months of a downturn in sales, and we've seen one strong month of a rebound. And we certainly took a cautious tone in our release, saying there's a lot of factors, there's a lot of unknowns that could influence the market, one way or the other. I certainly think there's both, upside risks and downside risks to, our outlook through the remainder of the year. So, for example, what happens if we see a resurgence in cases? What's going to happen south of the border, where we're seeing, a turnaround in the case level there, and we're seeing a pullback in some states, economies? How does that feed through into trade with Canada and our other trading partners? And so, I think there are a number of things that we're going to have to keep an eye on. I know a lot of people have been sort of thinking about mortgage deferrals, and as that opportunity runs its course, and people will be looking to make those payments again, say come the fall, how is that going to impact? And I think how that feeds through depends a lot on how our reopening continues to unfold. We haven't seen the labor market numbers as of yet. They'll be coming out tomorrow. But if you look at, say the scenario in Montreal, we started opening up, sooner that we saw in the GTA. I mean, they did see some positive job numbers. And so if we start to see that, steady lift in jobs on a month-over-month basis, then probably the notion of defaults on mortgages and what have you becomes less of an issue than if we see a stagnant labor market or continued job declines. And so, again, it's early days, and I think the next couple of months in terms of, the trends we're seeing in the market, but the broader trends in the labor market and especially which segments of that labor market are getting back on track, will give us a lot of information in terms of what we should expect in the fall, and maybe even more importantly in 2021.
Now, one other prominent forecast or outlook is that of the Canadian Mortgage and Housing Corporation, CMHC's forecast, an organization I believe you're very familiar with, which is perhaps one of the more pessimistic forecasts, predicting a decline in home prices up to 18%, with the full recovery taking place over 2 to 3 years, with acknowledgement that recovery would be uneven across Canada, with some cities perhaps recovering more quickly if they have more of the office-based jobs that can be done. I'm just wondering what your views are. You've touched on a couple of risk factors of what would make your outlooks perhaps a little different. What do you think are the biggest reasons why your outlooks are different?
Well, I think number one, like if you look at the Canada Mortgage and Housing Corporation's latest housing market outlook that came out in the summer, is somewhat of a special edition, if you will, and they certainly noted that there is a wide range of possibilities in terms of that forecast. In fact, they provide a low and a high for each metropolitan area across the country, and so while the 18% number got a lot of press, it's not necessarily, the only trajectory that they have in their outlook. It's important to point out also that if you think about CMHC, they're an underwriter from a mortgage insurance perspective. They also play the key role in the mortgage-backed security market in Canada as well. And so I think understandably, when they're undertaking their internal forecasting, which also, feeds their public commentary on the market, I think it's reasonable to assume that they take a more conservative approach, because they're thinking about, obviously, the insurance that they have in effect, and also the mortgage-backed security program that they're managing as well.
And now I wonder if we could talk a little bit about supply. So you had mentioned that sellers, as we went into lockdown, did hold back. And so when buyers dropped off because they had to stay at home, listings also went down. And those two things going together held prices, kept them from falling. Now, as you've mentioned in June numbers, it looks like sales volumes are back to year-over-year levels. So it seems to suggest that all of the sellers are back. However, anecdotally, we're hearing about, for example, older sellers who may still be reluctant to list and expose themselves to COVID and COVID-related issues. Or, for example, somebody else suggested maybe the older seller whose backyard is looking a lot better and is now thinking, I don't really want to downsize that quickly. So I'm wondering what you think about that seller supply, the seller-generated supply. Where is it at?
I mean, supply in our market has been a concern, at TREB broadly, but it's been a concern of mine for a number of years now, because it's clear that the appetite for making a purchase in the home ownership market remains strong. I mean, even as we're moving through the period of time that we're in right now, and our concern though is that because we saw a couple months of sales down quite substantially, the concern is that especially from a policy perspective, we'll lose track of the fact that we are seeing a sustained shortage of inventory in many segments of the market, moving through 2019 and into the first part of 2020, to the point where market conditions were tightening up again. We were moving towards once again double-digit year-over-year growth in pricing, and getting back to that peak that we had seen back in the first quarter of 2017. And looking forward, I think credit where credit is due. Policymakers at the municipal level, the provincial and federal levels, certainly acknowledge that there's supply issues, both in the aggregate, just in terms of the number of units we need to bring online, given the population growth that we should expect in the GTA, but also the diversity of types as well. So we hear terms like missing middle and what have you. And it is important to note that there's probably a lot of neighborhoods around the GTA where you don't have a diversity of housing to see people move through that sort of housing continuum over time, both up in the market, and then, as you mentioned, as people grow older, they may want to move, or downsize in the marketplace as well. And allowing that greater diversity, a lot of that has to do with, the planning process, the approval process, and what have you. And we are seeing movement on the policy front where different levels of government are looking at possible solutions. But in fairly short order, we need to move from, sort of looking at solutions on paper to, pouring more foundations on the ground for a greater diversity of these types. And I think, that would put us in good stead, medium to long term, in terms of both housing affordability, but also competitiveness. Like if you think about, a region that's going to attract, people to jobs across a number of different sectors of the economy, one of the factors that can set one region apart from others is an affordable supply of housing, both in terms of ownership and rental. And I think, looking at, ways to streamline the approval process, looking at ways to bring on a greater diversity of housing types, both in traditional neighborhoods or built up neighborhoods, as well as new neighborhoods, would go a long way to helping with that.
So I know you have a background in planning, and I've often thought about the types of housing that I'd like to see more of in Toronto. I've always wondered why we don't have more of those Montreal-style walk-ups, for example. I mean,
Sure.
There's snow, but the Montrealers seem to ski down the outside stairs okay. I'm wondering if there's a type of housing you wish we would see more of in Toronto, or that you think there's some growth room for.
I think, there's been a lot of work done. I mean, Treb does a couple of forecasts each year looking at consumer sentiment. And one thing we always find is that, people there's still a lot of focus on ground-oriented home types. So whether you're talking about a detached or a semi-detached or what have you. And, I think there really is a lot of room for, more ground-oriented housing that's coming in at that sort of mid-density type of levels, whether you're talking about plexes or more stacked or that kind of thing. And some of that has to do with, there's obviously sometimes resistance in certain neighborhoods to have too great of a diversity of home types. And I understand that people that are living in traditional neighborhoods, may have some angst around that. But we did some interesting, work done by Ryerson, Frank Clayton and his group at Ryerson, where they're looking at, other instances in North America where you did see a greater diversity of home types brought online. And in fact, it led to, an upwards trajectory in terms of home prices overall. And I think, the more complete that a neighborhood is across the housing continuum, the more desirable it's going to be. And obviously that has a positive impact on the value of, what amounts to many people's largest single investment that they'll make over time. So, I think that, we're headed in the right direction in terms of the policy research that's being done. But, policy on paper versus, what happens on the ground are two different things. But, like I say, I think we're headed in the right direction. The next step is to, start to see, more construction of a greater diversity of home types, both on the rental side and the ownership side. And we can't forget the rental market either. We talked about condominium investors in that earlier. It's been the condominium investor by and large that has added stock to the rental market in the Greater Toronto area over the last decade. I mean, we have seen an uptick in purpose-built rental construction and investment in that space, and a lot of that was due to the strong rent growth that we were seeing. But by and large, that's still coming from that individual investor. And so, there needs to be that balance as well. Often the condo investor is sort of a vilified actor within the overall housing market. But I think it's important to remember that, those people are taking on a certain amount of risk, and they've been providing a real service in terms of rental accommodation as well. So, it's going to be very interesting to see how things play out from a policy perspective, both, on bringing ownership housing online, but also the way in which we see rental housing come online over the next few years.
So picking up on what you were saying about that demand, the longer term demand, you spoke of a really hot, and like the market was very hot before COVID came along
Right.
in March. So that was 17% in February, year over year growth in prices. And that was after a relatively more modest growth back in 2019 of 2 to 6%. So what do you think was happening precisely in February there?
Yeah, I think what you're seeing is and you know, it was a topic that we kept coming back to as we moved through our releases, is that, you know, when you see a major policy move like the OSFI 2 percentage point stress test, I mean, there's always sort of a whipsaw, if you will. There's an immediate effect where, you know, if one month I was thinking about buying a detached home, but now I'm having to qualify 2 percentage points higher, and forget about whether you think that's a good idea or a bad idea in terms of a policy, but, you know, that was the policy of the day now. And so a lot of people had to, you know, take a step back and sort of reassess their situation in the market. Were they going to simply save up more money on a down payment to offset that qualification requirement? Were they going to look at a different type of housing at a lower price point? Were they going to look in a different area, or some combination thereof? And that takes time, because if you're on one track to make this large investment and now you got to switch to another track, you know, you're taking a step back, you're talking to your family if you have one, and sort of thinking about, you know, where you stand. And so that takes a number of months. And so, you know, we really went through most of 2018 was a down year. And we started off 2019 with you know, relatively slow sales as well, but things started to pick up, and it was about that sort of 12 to 18 month period, and you started to see people move back into the marketplace again. And I think we were just seeing a continuation of that as we handed off from, you know, December to January in 2020, and it was accelerating further as we moved through March. I mean, we were seeing, as I said earlier, you know, a $930,000 average price in the first couple of weeks of March. I mean, March was setting up to be, you know, a really strong month, and, you know, we're going to be looking at, you know, likely 10,000 plus sales April, May, and June. But obviously, you know, COVID-19, you know, put the brakes on that.
So another factor in that long-term demand has always been believed to be, and I think the numbers do show, is immigration. So immigration to the greater Toronto area. And so I'm wondering what you think now that COVID has done a couple things. First of all, there's a processing slowdown just in general of applications. There's restricted travel, global health concerns. Obviously, there's also rising unemployment in Canada, and foreign students who for such a long time have had an important relationship to the real estate market here, as parents would buy properties for foreign students attending here. What might happen now that those foreign students are either restricted from coming, or perhaps their classes are online anyway, and so they don't necessarily need to be in Canada? So I'm wondering what you think that impact will be on demand going forward.
Sure. I mean, let me start just sort of broadly with population growth. I mean, maybe if you think about Canada and how we see our population grow, you know, the GTA is, I would argue, the single greatest beneficiary of immigration to our country. You know, but for immigration, I mean, we don't have the economy we have right now. We don't have the diversity in our region that acts as a virtuous circle. I mean, it's our diversity both from an ethnic and cultural standpoint, as well as from an economic standpoint, that acts almost as a virtuous circle. It continues to attract more and more people. It compounds in a positive manner, and that's a key factor why we've seen, by and large, you know, a pretty steady uptick in demand both for ownership and rental housing. So obviously that's been on hold, you know, to a certain degree as we move through these last few months. But do I believe that, you know, long term we're going to see a return to that? Absolutely. You know, I mean, nothing's changed to a certain degree. I would say our economy coming out of COVID-19 will become more flexible, and there'll probably be, you know, more opportunities from a lot of people moving from different parts of the world to apply their skill set or trade to opportunities here. So, you know, long term, you know, I'm a big believer that we'll continue to benefit from population growth based on immigration, and the housing market and our economy more broadly will benefit. Thinking about, you know, particularly non-permanent residents, so you see that often, and certainly, you know, when you dig into the population growth numbers, that's been a key factor that's certainly driven rental market demand and arguably some investment on the ownership front as well. For example, people buying condos for their son or daughter to live in while they're at school and this type of thing, and perhaps, you know, stay longer when they're done school and work. So, you know, long term, the situation is probably still supportive for that. But I think, you know, shorter term, that could have it could have an impact both on the ownership and rental side. Again, as we talked about earlier, I think that the rental market is still, the segment of the broader housing market that's most in flux right now. And so, you know, like I said, we're 3.5 months into this. And so I think definitely sort of looking at those population numbers, looking at the, and looking at how that feeds through into specifically the rental market will be key over, you know, as we move through the second half of 2020.
So we had a great question from a Summit viewer around data metrics. And their question was, besides supply and demand, or often referred to as months of inventory, what other metrics are useful in trying to see where house prices might go? I'm wondering if you have any idea, any favorites or things you like to keep.
Sure. I mean, we're really lucky in the, you know, when you're forecasting the housing market versus, you know, other sectors of the economy. I mean, you really do have a visible indicators of supply and demand. At the end of the day, I mean, that is what drives price growth. And you know, I mean, not to get too nuts and bolts, but I mean, you know, if you're running a model on pricing, I mean, one of the first things you're going to do, you can take months of inventory, you can take the sales to new listings indicator or what have you, and you can you can, you know, come up with a pretty decent forecast on that basis as well. You know, I think another indicator that's always interesting to look at is the interplay of mortgage rates in terms of the average principal and interest payment, because you can turn that on its head and come up with sort of a justified price for different segments of the market, and use that to see whether you're sort of trending above or below sort of what that justified price would be based on, you know, affordability measures that are used for underwriting. So oftentimes I'll look at that, like that's a good sort of reality check in terms of what your price forecast may be. But to do that, you need to have a good understanding of what people are really sort of putting down. I mean, oftentimes we'll think about, or the stories we hear about is, you know, you got all these people buying houses in the GTA and they all putting down the minimum down payment and what have you. And if that were true, that would be concerning. But what we find, at least from our consumer polling, is that, you know, by and large, you know, the majority of people that said they purchased a home over the last 12 months, or those that are looking to purchase over the next year, you know, are generally over that 20% threshold, even in the first-time buyer space. So obviously on the first-time buyer front, you know, you're probably seeing down payment sources come from a number of different places. But, you know, I think, you know, beyond the traditional supply and demand metrics, I like to kind of take some of those consumer polling numbers and looking at, well, what's the average buyer likely going to be putting down? And how does that compute through to what a justified price would be based on affordability metrics for different segments of the market? It's a good reality check on your overall price forecast.
Jason, you came to TREB from CMHC in 2008 amidst another market downturn, and that was generated more by a real estate issue, the US subprime mortgage crisis.
Right.
What makes this COVID-generated crisis different, in your opinion?
I think it's just, you know, and don't forget, I mean, the housing market actually in Canada turned around relatively quickly. I think that was testament to, you know, the underwriting standards that were in place then, and if anything, they're stricter now. And so the average homeowner, you know, was well placed to, you know, weather an economic storm. And we saw that if you look at, say, mortgage defaults, even in 2008 to 2009, sure, they went up, and that makes sense that they would have. Some households found themselves in financial distress, but they didn't spike like we saw south of the border. So again, it speaks to a more conservative lending environment in Canada, and one that's gotten more conservative since that period of time in terms of dialing back some of the options you had in the insured mortgage space, and now the OSFI stress test on top of that. And so, you know, thinking forward, into the second half of this year, especially if we could start to see, a pretty sustained recovery in terms of jobs and what have you, I think you can make the argument then is that, that conservative lending, the fact that a lot of borrowers have a lot of skin in the game in terms of down payment and equity in their homes, that, that'll put the market in fairly good stead moving forward. But, in terms of, other differences, I mean, I don't think there's anyone forecasting any segment of the economy right now that could say, I have some precedent that I can lean on to make a rock solid forecast in terms of what we're going to see over the next few months. And to your point, there's been a great diversity of forecasts for the housing market, of forecasts for the labor market, and that's because it's sort of new ground. And obviously the hope is that we won't have to turn back and look at the COVID-19 anytime soon as we move forward to make another forecast in this type of situation.
So given that these crises are very different, are there any general rules of thumb that you can take applying lessons learned from one crisis to the other?
I think if anything, you really got to dig into, like, it's one thing to say, look, the unemployment rate has spiked, or the number of jobs is down. In the aggregate, I think, you really got to dig into those numbers a lot deeper, whether you're looking at, employment by age, or whether you're looking at employment by sector, and how that correlates with income. Because I firmly believe that, one of the reasons why, we've seen a pretty strong bounce back in home sales is because a lot of those sectors of the economy that support, above average earners, who by and large would be pointed at home ownership, those sectors haven't been affected nearly as much as sectors that would see, say, younger people working in them, those sectors that are sort of population facing sort of storefront type sectors. And so, it's important to really sort of dig into those trends and sort of see, how the economy has been affected. And there really has been an asymmetry in terms of, the public health, shutdown of many businesses that we saw. That's had an asymmetric effect on labor markets.
So I'm not going to have you predict how long COVID will dominate the real estate market story. That would be totally unfair. But I am wondering what you think about whether there will be other storylines that will emerge even by the end of the year.
Sure. I mean, I think it's reasonable to assume that, the story hasn't played itself out in terms of, what the post-COVID period looks like. Like, now that we've learned that we can transition from the traditional workspace to the home workspace, fairly well. How does that impact, the use of different types of commercial space moving forward? How does that impact where people choose to live and the types of homes that they're looking to live in? And so, I think those types of trends, and to a certain degree, I think it bears further research in terms of, consumer sentiment tracking and that type of thing to start to get a feel, where people may be looking, 1 or 2 years down the road, both in terms of where their place of work is going to be, but also, what they see as, I guess, their optimal living environment and that as well. Because we're 3 months in, there's still a lot of people that are working from home from their dining room table and what have you. And, is that something that you want that people will want over the long term? Maybe not, and that may dictate either some form of return to work, and so we'll have to see how that unfolds, or changing your home environment to account for working and living. So I think the demand for both commercial space and the types of housing, I think that's still very much in flux, and that'll probably be the storyline. In terms of once we're sort of through the short term, recovery from COVID-19 in particular, how does that sort of change, longer term preferences, both for a place of work and how that workplace looks, and also, how people, live vis-a-vis their place of work.
Yeah, it's very true. We're already seeing some reports, a lot of suburban locations in cottage country picking up in terms of the real estate markets. So that'll be interesting if that's part of that longer term adjustment too.
Sure.
The question, if I do get locked down again, where do I want to be? Which
Right.
is a very unusual question that we would never have been asking ourselves back even just a few months ago.
That's very true.
The theme of our conference is smart caution. I'm wondering what that means to you.
Well, I think just, we're basically, we had a 2-month, dip that was fairly serious in the marketplace, and now we've seen a 1-month rebound. Certainly when I was speaking about, sort of a revised outlook through the remainder of 2020, that was predicated on, if we continue to see the gradual reopening of the economy and what have you. But I think it would be foolish at the same time to say, there won't be bumps along the road. And so, I'm cautiously optimistic that, we'll continue to see a reopening of the economy. I think consumer confidence has improved a lot over the last month, just in terms of people's ability to get out and about, more freely, adds a lot to people's confidence that things are going to improve. So, I think that, like I say, I'm cautiously optimistic, but I think we have to be prepared that there may be some bumps along the road as well.
And the final question that we're asking all our experts is, would you buy or sell a home right now?
I think if I'd been thinking about purchasing a home, as we move through the first quarter of this year, and both my wife and I were comfortable in our employment situation moving forward, I'm upbeat on the GTA over the long term in terms of a place to work and its ability to attract new people into the region, and all of them are looking for a place to live. And so I think that certainly bodes well for the housing market. And so if I was thinking, that from a financial perspective, I'd be moving through this sort of shorter term slow patch. I remain optimistic on the GTA housing market over the long term.
Jason, thank you so much for joining us at the summit.
You're very welcome. Thanks for having me.